There is a moment in history that financial textbooks often miss. It is the moment the trust breaks and the physical asset vanishes. Just 47 days. That is all it took for 37.6 million ounces of registered silver to disappear from the vaults of the COMEX. Gone. The largest concentrated drain since 1980. Do you remember what happened in 1980? Silver screamed, from $6 to $49 in a single year, shaking the foundations of Wall Street. But the real seismic event happened far away from the trading floors of New York. On February 14, 2025, 4 major banks in South Korea institutions with unlimited capital and global sourcing networks simultaneously suspended the sale of physical silver, not for a day, not for a week, indefinitely. When the custodians of global wealth cannot source the metal, what does that tell you about its availability? This is not speculation, this is stage 3 of a 4-stage pattern that has played out 3 times before in human history. The price of silver hitting $100 is not the goal. It is simply the symptom of the system breaking. When stage 4 arrives, the price will not matter, because at any price, you will not be able to find a single ounce. You are about to understand exactly where we are in this pattern, why the silver crisis is fundamentally different from every other market squeeze in history, and the $17 billion lesson the Hunt brothers taught us about the catastrophic risk of owning a promise versus owning the asset itself. Stay with me. The window is closing. The 4-stage pattern of asset collapse and revaluation is brutally simple. It is a historical constant, an economic law of physics that has defeated every fiat system ever conceived. The pattern is based on a single principle. The system always replaces physical reality with paper promises until the promises exceed the reality so greatly that the structure collapses. This pattern is not theoretical. It has been proven by the collapse of the Roman denarius, the hyperinflation of the Weimar Republic, and most recently, the destruction of the global gold standard. Let us define the stages clearly. Stage 1. Establishment. A commodity is chosen to represent value, becoming money. Governments back their currencies with it, providing stability and trust. This stage can last for decades, even centuries. For silver, this was a 150-year period. From the founding of the United States until 1964, silver was intrinsically linked to the US dollar. Every American coin, until that date, contained 90% silver. You could walk into any bank with a paper dollar and demand physical silver at face value. This stable, predictable, and fully trusted system was the bedrock of global commerce. Stage 2. Manipulation and financialization. This is the turning point, the inflection point where trust is weaponized. Bankers, traders, and governments realize that issuing paper claims against a finite physical asset is immensely profitable. The physical metal is expensive to mine, transport, and store. The paper claim is cheap to print, easy to trade, and offers massive leverage. 1 ounce of physical silver becomes the backing for 10 paper contracts, then 50, then 100. Futures, exchange-traded funds, certificates, and derivatives flood the market. This creates an illusion of infinite supply. By overwhelming the market with paper promises, the price of the physical asset is artificially suppressed. The price drop is not a sign of low demand. It is proof of financial manipulation, where paper is allowed to dictate the price of the physical reality it supposedly represents. For silver, this stage accelerated after 1965, when the US removed silver from its coinage because the market price of the metal had begun to exceed its face value. The government had already begun to devalue its currency against the underlying commodity. Stage 3, the squeeze. This is where we stand today. The manipulation works only as long as people accept the paper and do not demand the physical asset. But eventually, demand grows, driven by industrial users who need the metal or by investors who lose faith in the paper system. People start demanding physical delivery of the metal tied to their contracts. The vaults begin to drain. A critical mass is reached where everyone realizes, almost simultaneously, that there are not enough ounces of physical metal to cover the hundreds of millions, sometimes billions, of paper claims. This realization triggers a bank run on the commodity. Panic buying ensues. The paper price becomes meaningless as the premium for immediate physical delivery skyrockets. Backwardation appears a screaming signal that the current spot price is lower than the true value of immediate physical possession. The market is desperate for the metal today, not a promise for tomorrow. Stage 4. The break. This is the inevitable conclusion. The paper market collapses. The exchange, unable to source the physical metal, is forced to halt trading. Delivery failures cascade. Contracts are forcibly cash settled against the will of the buyer, meaning the buyer is given worthless fiat currency instead of the physical asset they paid for. The price of the physical asset goes parabolic, divorcing entirely from the frozen paper price. In the end, only two groups emerge: those who held real metal in their possession, who win, and everyone else who learn an expensive. Generational lesson about owning something versus owning a promise of something. The most dramatic historical proof of this pattern is not the silver market of 1980, which we will analyse in Part 2, it is the end of the Bretton Woods system. In the late 1960s, foreign banks started demanding physical gold in exchange for the US dollars they held. America did not have enough gold to cover its liabilities. The paper promise was failing. On August 15, 1971, President Richard Nixon closed the gold window, ending the convertibility of the dollar to gold. Gold shot from $35 an ounce to over $850 an ounce within a decade. Silver followed, moving from around $1.40 an ounce to over $49 an ounce. The pattern holds: remove the physical backing from the money, and the physical asset explodes in value while the paper loses its trust. We are now watching this exact playbook unfold again, but this time in the silver market. To understand the severity of our current situation, we must analyse the most dramatic silver squeeze in history, the saga of Nelson Bunker Hunt and William Herbert Hunt. Their story is not just a tale of wealth and collapse, it is a clinical demonstration of how paper leverage can be surgically neutralised by the system it threatens. The backdrop to the Hunt saga was a monetary crisis brewing since 1971. The dollar had lost its gold backing. By 1979, the inflation rate in the United States was screaming above 13%. The Hunt brothers, Texas oil billionaires, correctly recognized that fiat currency was rapidly losing its value, and they sought refuge in real assets. They were fundamentally right about the death of the dollar's purchasing power. Starting in 1979, they began accumulating silver. Their approach was aggressive and relentless. They utilized a dual strategy, buying massive amounts of physical silver and buying an equally massive number of futures contracts. A futures contract is not physical ownership. It is a promise of future delivery, secured by a small fraction of capital known as margin. This allowed them to control hundreds of millions of ounces of silver without owning the vast majority of it outright. By early 1980, they controlled an estimated 200 million ounces, roughly half in physical form and half in paper contracts. Their buying power, combined with soaring inflation, drove the price parabolically. In January 1979, silver was trading at around $6 per ounce. By September, it was $10. By the end of December, it had shot past $30. On January 17, 1980, silver hit its historic peak of $49.45 per ounce. This represented a staggering 724% return in just 12 months. Wall Street and the commodity exchanges were in open panic. Why? Because the Hunts were not simply betting on the price, they were demanding physical delivery on their futures contracts. They were converting paper promises into metal, draining the COMEX vaults at an alarming speed. If the Hunt brothers continued to demand delivery, the exchange itself would run out of silver and fail, triggering a cascade failure across the entire financial system. The exchange and the large bullion banks, which held massive short positions, bets that the price would fall, could not allow this physical drain to continue. When the system is losing, it does not allow the market to run its course. It changes the rules. On January 7, 1980, the COMEX invoked what became known as Silver Rule 7. This rule was a declaration of financial war. It stated that all trading must be for the liquidation of existing contracts. Translation: no more long positions. You could sell silver, but you could not buy any new contracts. The market was frozen in place, designed specifically to lock the Hunt brothers and other long holders out of the game while allowing the exchange to cover its shorts. But the price was so strong that it initially kept climbing despite the freeze. The system had to deploy the nuclear option. On January 21st, margin requirements, the cash deposit required to hold a futures contract, were raised drastically, several times over. Overnight, holding their massive paper position became impossibly expensive for the Hunts. They needed hundreds of millions of dollars in additional margin immediately. The cash simply was not there. They were forced to sell their holdings to meet the margin calls. This massive, forced selling triggered a chain reaction. Other speculators panicked and sold their contracts. On March 27, 1980, a day now infamously known as Silver Thursday, the price of silver collapsed from $21 to $10 in a single trading session. The Hunt brothers lost an estimated $1.7 billion, forcing them into bankruptcy. The lesson is not that silver is a risky asset. The lesson is about the fundamental difference between speculation and ownership. The Hunt brothers failed because they relied on leverage and paper contracts. The system, through the commodity exchange, changed the rules mid-game to protect itself. You cannot change the rules on something you actually own. Here is the undeniable, forgotten truth. The people who held physical silver, not futures, not paper certificates, did not lose anything. When the dust settled, silver was still trading at $10 per ounce. That is still 66% higher than the $6 price where the run began. Those who saw the pattern early, bought physical, and held it through the chaos emerged with generational wealth. The system can manipulate paper, but it cannot print metal. This is the crucial distinction that separates those who thrive in the coming collapse from those who are wiped out by the rule change. To focus solely on the paper market manipulation, the futures contracts, the margin calls, and the rule changes is to miss the fundamental difference that makes this silver crisis far more dangerous than the Hunt brothers saga of 1980. Back then, silver was still primarily viewed as a monetary metal. Today, silver suffers from a dual crisis. It is simultaneously the most manipulated monetary metal and the world's most critical and depleted industrial commodity. The industrial dependence. Unlike gold, which is almost 90% reserved for jewelry and investment, silver is consumed by industry. Approximately 55% of global silver demand is destroyed in manufacturing processes and never recovered. Every technological megatrend defining modern civilization depends on the conductivity and resilience of silver. Consider these critical facts. 1. Solar energy. The world's transition to green energy is ravenous for silver. Solar photovoltaic cells require silver paste to conduct the electricity generated. The solar industry now consumes approximately 12% of the world's annual silver supply. The University of New South Wales conducted a study projecting that current solar panel manufacturing could potentially consume 85 to 98% of global silver reserves by 2050. The Industrial Revolution built on green energy is essentially a debt owed to silver. 2. Electric vehicles. An electric vehicle uses approximately double the amount of silver found in a traditional internal combustion engine car. As governments mandate the phasing out of gasoline vehicles, the demand for silver in automotive electronics, switches, and charging infrastructure explodes. 3. 5G and data centers. The explosion of artificial intelligence and 5G connectivity requires massive data centers. Silver is essential for the superior conductivity needed in high-speed, low-latency devices and connectors. Every new server rack, every advanced communication system is an additional claim on the diminishing physical supply. The deficit crisis, 4 years of shortage. Physics does not care about economic models or central bank policy. You cannot algorithm your way out of a geological deficit. For the past 3 years, the world has consumed more physical silver than it has mined. We are now in the 4th consecutive year of this deficit. According to the authoritative data published by the Silver Institute, the physical market deficit reached a staggering 148.9 million ounces in 2024. The projected deficit for 2025 is still expected to be over 117 million ounces. This deficit is not a small margin error. It represents a systemic failure of supply to meet demand, and the trend is accelerating. Asterisk, mining decline. Global mine supply has been declining steadily since its peak in 2016. Silver is often mined as a byproduct of copper, lead, and zinc. When major mining companies face headwinds or geopolitical risk, the supply of byproduct silver immediately suffers. Asterisk, recycling limits. Unlike copper, where a large percentage can be recycled, silver used in electronics is often in tiny, dispersed quantities, making the energy and cost required to recover it prohibitive. Recycling cannot keep pace with the massive industrial demand, meaning the deficit must be filled by draining existing, above-ground physical inventory, the very COMEX vaults we discussed. The global hoarding effect. This severe industrial deficit is colliding head-on with a profound shift in global monetary strategy, driving Stage 3 to a catastrophic conclusion. Nation-states are recognizing the pattern. China, which is hoarding precious metals for its state reserves, has repeatedly raised risk classifications on metals, restricting its citizens from buying through banks. This is a clear move to preserve the physical supply for state interests. Meanwhile, India, a nation with deep historical experience in currency crises, saw its silver imports hit record highs in 2024. Indians know that when paper money fails, physical metals are the only true protection. The rise of the BRICS nations Brazil, Russia, India, China, and South Africa, and their efforts to build an alternative payment system is rooted in the move away from the debt-based US dollar fiat system. While gold is the primary focus of central bank accumulation, silver's unique dual role as both a critical industrial metal and an alternative money makes it a necessary component of this new multipolar economic architecture. The paper traders can issue more contracts, but they cannot mine a single new ounce. Nor can they power a single solar panel without the physical metal. The world is physically running out of silver at the exact moment global monetary trust is collapsing. This is why the window is closing, and why stage 4 is not a probability, it is a mathematical inevitability dictated by supply and demand physics. We have established the historical pattern and the underlying physical constraints. Now, we must turn to the hard data, the undisputed numbers released by the exchanges themselves that confirm we are not merely approaching stage 3, but are deep within the squeeze right now. The market is not whispering the truth, it is screaming it. Here are 5 undeniable proofs that the paper-silver market is breaking. Proof 1. The emptying COMEX vaults. The COMEX, the primary exchange for silver futures trading, tracks its inventory in 2 categories, registered and eligible. Eligible silver is stored but not available for immediate delivery against a contract. Registered silver is the only metal available for immediate delivery to traders who demand the physical asset. On October 1st, 2024, the COMEX registered vaults held approximately 80 million ounces of silver ready for delivery. By December 3rd, 2025, this number had collapsed to just 43 million ounces. That represents a drawdown of nearly 50% in barely a year. This is not normal profit-taking. This is the definition of a bank run on a commodity. When futures traders demand delivery, they are competing for a mere 43 million ounces to cover an open interest that measures in the hundreds of millions of ounces. The gap between paper contracts and physical reality has become a chasm. Proof 2. The South Korean banking suspension. We reference this in the hook, but the significance must be analysed clinically. When 4 of the largest financial institutions in a technologically advanced, capital-rich country like South Korea, Shinhan Bank, KB, Kookmin Bank, Hana Bank, and Woori Bank simultaneously suspend all silver sales on February 14, 2025, this is not a localised logistics issue. These institutions can procure anything. Their suspension signals a failure at the fundamental level of global physical sourcing. The silver is simply not available at a price they can responsibly resell, forcing them to step back from the market indefinitely. This action alone is a 5-alarm fire for physical availability. Proof 3. Persistent backwardation. In a normal commodity market, the price of a futures contract should be higher than the immediate spot price. This is called contango, covering the costs of storage, insurance, and the time value of money. When the spot price, the price for immediate physical delivery, rises above the futures price, it is called backwardation. This inversion is one of the most powerful signals of physical desperation. It proves that market participants are so worried about immediate supply that they are willing to pay a premium to secure the metal today rather than risk a default on a promise tomorrow. This is the market screaming panic buying, and it has been persistent, indicating a long-term structural supply problem, not a transient event. Proof 4. The CME trading halt analysis. On a specific day in November 2025, the CME, the parent company of COMEX, experienced a trading halt during a period of high volatility. The official reason was cited as a cooling failure in their data center. Veteran traders know better. This is a military-grade trading infrastructure handling trillions of dollars daily. When exchanges halt trading mid-spike, it is an emergency move designed to relieve pressure and buy time, almost always because a major short holder, usually a bullion bank, is facing catastrophic failure. This is the exchange choosing to protect the short positions by interrupting the natural market forces, exactly as they did in 1980. Proof 5. Exploding premiums and retail shortages. The true price of physical silver is not the spot price listed by the exchanges, it is the spot price plus the premium charged by physical dealers and mints. Retail buyers are currently paying premiums ranging from $3 to $5 over spot for recognized forms like American Silver Eagles or Canadian Maple Leafs. During the early stages of the squeeze, these premiums quickly spike to $20, $30, or $50 over spot. When online dealers report inventory shortages and mints report year-long waiting lists for delivery, the paper price is a lie. The only price that matters is the price at which you can actually acquire the physical metal. That price is escalating rapidly, confirming the physical exhaustion of the global supply chain. These 5 data points taken together leave no room for debate. We are past the point of simple manipulation. We are in the active squeeze phase. The only question left is when the transition to stage 4, the break, becomes complete. The pattern is complete. History provides the template, data provides the confirmation, physics provides the constraint. The window for cheap, available physical silver is closing not because of hype or speculation, but because the vaults are empty, the banks are pulling back, and the world's industrial machinery must run on metal that simply is not being mined fast enough. When stage 4, the break, fully arrives, the paper market will not fall gracefully. Trading halts will become commonplace, contracts will be suspended, liquidation failures will cascade. You will see lawsuits and investigations filed, but by then, it will be too late. The system will forcibly cash-settle contracts, meaning you will receive the collapsing fiat currency instead of the physical asset you believed you owned. The people who saw the pattern early will be watching from a position of absolute safety. They will have won because they understood the fundamental lesson of the Hunt brothers. You cannot change the rules on something you actually possess. So, here is your final playbook based on historical success and logical necessity. Possession is protection. Do not buy paper. No futures, no cash-settled exchange-traded funds, no digital promises. Your only option is physical metal in your direct possession, in your home safe, or in a private vault where you alone hold the keys. Eliminate all counterparty risk. 2. Buy now. While premiums are rational, today premiums are a few dollars over spot. When the squeeze accelerates, premiums will jump to $20, $30, or $50 over spot. Eventually, dealers will be sold out, and mints will have year-long waiting lists. Your cash will be losing value, unable to convert to the asset gaining value. 3. Focus on liquidity and recognition. Purchase forms that are universally recognized and easily authenticated. Stick to high-purity silver bars or sovereign coins like the American Silver Eagle or the Canadian Maple Leaf. Liquidity matters most when the system is in chaos. Or allocate appropriately. This is not about going all in. This is insurance against monetary failure. Convert 10 to 20% of your liquid assets to physical silver, enough to protect your wealth, but not so much that an unexpected event destroys you. Balance caution with decisive action. Every fiat currency in history has failed. The US dollar has been fully fiat since 1971, that is, 54 years on borrowed time. You cannot print silver. You cannot policy your way out of a physical deficit. The clock is ticking. Recognize the pattern, trust the data, and act while the opportunity still exists.